Let's move on. Our next guest expects stocks to rebound this year to new all-time highs. Chris Harvey is the head of equity strategy at Wells Fargo Securities. Chris, welcome. Good to have you here. You say this is going to be a good year, but a bad vintage. What do you mean by that?
So I think equities are going to go up this year, but people are going to put on too much risk, right? So for the last couple of years, people have been playing momentum. I buy strength, I sell weakness. That's comparable to I keep pushing my bets. I keep pushing my bets into the table. That's fine, but it builds up risk over time. The other thing is people are going to start to go out on the risk, too far out on the risk curve and too far down the capital structure because the person to the right, person to the left is going to make more money, and there's going to be a bit of FOMO. So this is a year that I think equities do go higher, whether it's related to a good economy, the Fed's still cutting rates, M&A activity, IPOs. But when we look back from the perch of 27, we're going to say 25 was the year where people put on too much portfolio risk.
Are you with Bonawyn that this is going to be a year of heightened volatility or more volatility than we've had?
I think that's an easy yes. We didn't have much volatility last year. We had a spike in the beginning of, August, and that just disappeared after that. Credit spreads are still incredibly tight. We should see some spikes in volatility, or a lot more spikes in volatility. But
How do I play it? What do I do?
Yeah. What do you do? What we do is we've been barbelling some of the things that we really like, right? We like the communication space. We like banks. But we want to barbell that versus staples, right? Staples, unloved, underappreciated, and that's going to give your portfolio some balance. And in times when the market really trades off, that's going to help out the portfolio. So you really want to barbell something defensive with something you like, GARPy, something a little bit more cyclical.
Karen?
So when you're talking about investors being more levered, are you saying they themselves are more levered, or they're looking at things that are more levered, which the Mag 7 is not?
So what I think is they're going to put on more portfolio leverage. The other thing that we're going to see is more M&A activity, which will bring leverage into the system. Furthermore, when you look at credit spreads being this tight, you and I could go out and issue $200 million. I'm exaggerating, but you could issue a lot of paper, right? And so more leverage is going to come into the marketplace that way as well. So you're seeing on a portfolio level, you're seeing on a corporate level, and I think you're going to see a lot more risk-seeking as the year goes on.
What do you see, to Guy's point a moment ago, interest rates moving up? He thinks they're going to go up. What did you say, toward
at least 5%?
Toward 5%.
Yeah.
And what does that do to the overall? And your price target is one of the highest on the street.
Yeah, it's
7,007.
It's
7,007.
7,007. A big James Bond fan.
Dry, straight up. Shaken.
So what that does is that's not positive. But we do think that rates do peak in the first quarter. Bonds are actually a pretty good risk reward at this point in time. The compensation you're getting on bonds above inflation expectation is about 2.25%. You haven't seen that for a sustained period of time since 06, right, when the Fed was still raising rates, not easing rates. So yes, we can get rates go higher. I don't think you can sustain 5% for a long period of time. And I do think that rates will come down because the economy, I think, will slow down in the second half of the year.
Communication services is one of the elements of your barbell approach here. What are those companies? Which ones?
So that's your Metas, your Googles, your Netflix, some of your AT&T, Verizon, and some of the cable companies.
Yeah. And so you think those are well positioned, and financials, big bang. Financials is a big space. What are you emphasizing there?
So I think Karen hit it on the head before. With communication, it's that quintessential GARPy space. Yes, the stocks have done really well for the last 2 years, but valuation is still attractive. They're still able to commercialize, and they're one of the first ones to really be able to commercialize AI. And so the underlying fundamentals are still really strong. Technicals, momentum look really good. With regard to banks, I just think you're going to have upward EPS revisions for banks, and you're just still going to have relative multiple expansion for the banking space because of the regulatory environment.
If the year ends where you think it is, 7,007, is the first half going to be where the fun is, or the second half?
I think it's the first half, right? I'm worried if we do get close to that number by September or something, we really want to start de-risking the portfolio at that point in time. I do think we're going to start to see a lot more merger Mondays. I think you're going to see a lot more IPOs. Once you see that, people will have more money to play with. Their risk appetite will go stronger. And again, we're looking at a period where the economy is still strong, credit spreads are tight, the Fed is still easing, maybe not as much as we thought they would, and momentum is still very much in play. that's a pretty good recipe for upward stocks.
Chris, did you know that it's in my contract that if I host, you have to be here? It's like every time I'm here subbing, you are here. And we're glad you are. Thank you so much. Happy New Year, my friend.